Good morning and welcome to this Wednesday, September 9th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we saw some additional selling again on Tuesday, continuing that theme that we saw last week. I'm not sure it's over yet, but futures are at least pointing to a little bit of relief this morning. We're going to get into all that in just a couple minutes, but I do want to first point you to our website over at earningsbeats.com. And if you take a look, you have an opportunity here to sign up for our free Earnings Beats Digest newsletter. We publish a newsletter Mondays, Wednesdays, and Fridays in the morning, typically before the market opens. And we'd love to have you join. Simply type in your name, email address, hit that subscribe button, and you'll be a member and subscriber to that newsletter. You can unsubscribe at any time. There's no credit card required. It's a free subscription. Just an opportunity for us to provide some, I think, educational material more than anything, but there are obviously some trading opportunities that come out of the newsletter as well. But more, it's about just going through the earnings beats methodology, if you will. Just the way we look at the market, how we approach it, talk a lot about earnings, relative strength. Recently, we've talked a little bit about market direction. It was, I guess, a week ago, Monday, that I talked about warning. I was talking about warnings in the market, and I actually, in this newsletter, provided a potential target for the S&P 500 using Fibonacci, which was down just below the 3,300 level. And we've gotten pretty close to that level. And I'm sure there weren't too many folks when we were sitting up at 3,500 that were talking about that. But we closed yesterday on the S&P at 33.31. And I believe the number was like 32.98 or 32.91 was that initial Fibonacci level. So we've gotten within 1%. And actually the S&P got up to maybe, I don't know if it hit 3,600, but it got very close. Yeah, 35.88 was the high. So the S&P right now, before today's open, is down 257 points off of that high, which would be roughly about 7.25%. And when I was doing the warnings, that's kind of what I was talking about, was maybe 5 to 7%. I think we could have a little bit more downside, but we'll get into that, in a bit. I think we're getting close to what I expect is going to be the low. Maybe we'll have one more low. It is September, and the market, especially latter part of September, can be a little rough. But I do think once we get past that, I think the market will start looking toward some big earnings reports coming up in the fourth quarter. And I think that will get the market going again. So let's take a look at what happened on Tuesday. First of all, it was a down day. Kept talking about the market going up, 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 needed some relief, needed some consolidation, needed some basing. Well, I think we've started that. I think it's pretty obvious now. The Dow Jones on Tuesday down 2.25%. That's 630 points. We got up close to the all-time high and came right back down. But I do think in the fourth quarter, we're going to go through and break the all-time highs on the Dow. The S&P 500 down a little bit more than 2.75%. So a little bit heavier selling there than on the Dow. But the big selling was truly on the NASDAQ, down more than 4%, 465 points. And just a few days ago, we were over 12,000, closed yesterday at 10,847. It's about a 10% haircut on the NASDAQ. So NASDAQ definitely losing on a bigger proportionate level than the S&P and the Dow. But the Dow or the NASDAQ also was gaining more on the way up. So that's where you would expect some of the selling to appear on a relative basis, and that's what we've seen. Mid caps, though, still down 2.25%. Small caps 2.39%. So it was across the board, no doubt, the selling. I still believe we're in a secular bull market. I think this is actually healthy. I think this is much better than the market just going up day after day. And actually, we're seeing some of the effects of the market going up day after day. When we just kept going up, no pullbacks, no pullbacks. When you finally do sell, we go down a lot faster than we went up. It took us about 4 weeks to gain on the NASDAQ what we lost in 3 days. It's pretty amazing when you think about it. Looking at the individual sectors, technology took it on the chin big time. Of course, with the NASDAQ losing, that's what you would expect. The technology area very heavily weighted on the NASDAQ. But the last 3 days, we were up near 130, come all the way back down to a close of 112.78. So those of you who have been interested in ETFs but didn't want to chase technology, well, you're getting an opportunity here on this pullback before we head into the fourth quarter. And the fourth quarter historically is incredibly strong. There's one stat that I have, I may not get it exactly correct. I don't have it in front of me, but after earnings season starts, and I believe it's the close on October 27th, from the close on October 27th to the close on January 19th, or maybe it's 18th, that period has gone up since 1950. It's gone up 58 of the last 69 years. That's a pretty strong, it's, when you just think about 58 out of 69 years, it's almost 60. It's about 80, over 80% chance that we're going to see, maybe closer to 85% chance that we're going to see the market go higher during that period. So we've got that. That's still, I don't know, maybe 6 weeks away. But historically, the market does do well heading up to earnings season as well, usually the 2-3 weeks before earnings season kicks in. So by the end of September, I suspect the market's going to be in a much better position and in a little bit better mood than it's in right now. But anyway, technology rough, energy. This is an area that personally I've been saying to avoid. I mean, renewable energy has done pretty well, but outside of that, energy has just been very, very tough. And after looking, fairly strong first, second week of August, getting up to 40, we've reversed course. This group's down quite a bit in the last month and broke below, to 4-month lows. So not good action on the energy group. And I'm going to take a little bit closer look at energy in a little bit this morning. Communication services down 2.6%, financials 2.5%, staples 2%. Everything for the most part was down. So it was a whitewash, but these are the groups that took the brunt of the selling. One thing I will point out though, when you look at this, financials, look at the accumulation distribution, still in kind of a downtrend. Energy, still in kind of a downtrend. But even with the selling, look at the accumulation distribution on the technology group, a little bit of a pullback. You remember all that selling we had back in June? See, we had just a little bit of a pullback in the accumulation distribution and we broke out the new highs. The fact that we're just coming back a little bit here tells me probably this is not mass distribution. I doubt that this is portfolio managers and mutual funds and pension funds. I don't think they're getting out of technology. I think we're seeing a little bit of temporary profit taking, but I do believe we'll see money rotate back in. Communication services, same thing. Nice move up. Didn't really even pull back much in June when we saw this selling. You can see the AD line held up pretty well. We've had a pretty steep decline right here, and we really haven't gone down much in accumulation distribution. And what that tells us, if you're not familiar with accumulation distribution is based on whatever happens during the day. It doesn't factor in gap downs. So when we see a big gap down in the market, like we saw yesterday, and then sideways action, accumulation distribution doesn't get hit. On balance, volume gets hit, but accumulation distribution does not. And if you think about it, market, anybody who's going to sell a lot of shares, mutual funds, pension funds, hedge funds, these types of organizations, when they sell, they don't put a market order in at the open. They don't take that gap down. That's not why we get the gap downs. Market makers set those prices at the open. They look at what happened yesterday. They see the demand versus the supply at the open, and they can kind of manipulate the opens. It's not because you've got pension funds wanting to sell 1 million shares of Tesla. That's not why the market gaps down. And so I think that the accumulation distribution during volatile periods can be a great signal to watch. Are we really seeing distribution? If we were, we'd see this going down. Look at energy. When you get the selling here, I think it's pretty clear that there's actual distribution taking place. I don't see that same thing in these other areas, and I think that's important. All right, let's move on. 10-year Treasury yield. There's no economic reports due out today. Let's get an update here, get the latest. Pretty much just flat, sitting at 0.68%. I think after this move up that we saw in the second week of August, mostly sideways action, a little bit of volatility, but it's really just up, down, up, down. Are we going to break above 0.75%? If so, it's bullish. Are we going to break back down below 0.6? If so, that's that's more bearish. In either situation, I think the market goes higher. But if we're getting a breakout in the yield, to me, folks bailing out of the bond market is telling me areas like financials, transports, those are areas that could be leading us to the upside if we break out. If we break down to the downside, I would say it's probably going to be more of the same that what we've seen. I think everything's going higher. It's just a matter of which area goes up faster. And that may seem like contradicts what's been going on the last 3 or 4 days, but the market's not going to go up every day. And when it does, like I said, you tend to have these swift moves to the downside, which scares a lot of folks out that bought at the top. And then you got to kind of go through this basing period where everyone at the top is selling their shares, everyone at the, and you got others who are trying to accumulate. And that takes place for a period of time before we ultimately, in my opinion, make the next breakout. Okay, moving on. Let's take a look at the S&P 500. I want to show you the S&P 500 on a 60-minute chart, okay? So this is where we currently stand. That's where we were, and this is how swiftly we moved back down. I told you it's been a while, moving up to a few weeks, and then you move back down quickly and kind of erase all those gains. This is your visual of what's been taking place. Now, a couple things I want to point out on this chart. Number one, you can see as we've been moving down, accumulation distribution staying near the high. So a lot of this, again, when you have big volume on the open, but you come back up in the first hour about where you opened after putting in a lower low, that's actually a positive for accumulation distribution, even though price action was very negative from the prior day's close, because no one could sell. There's no selling that takes place during this gap. So once you gap down and the opening price is set at 930, that's when the buying and selling begins. And you can see that the action wasn't that bad. We gapped down, went down early, came back, and then at the end of the day, we did come back down a little bit. You can see the AD line took a little bit of a hit at the end of the day. But throughout this 3-day selling binge, we really haven't seen much deterioration in the accumulation distribution. The other thing I wanted to point out is where we stand right now on the hourly PPO, because I have a chart I'm going to show you historically what this could mean, where we are right now. But you see we're down below -1. We hadn't been this low in quite a while, since back in June. When we had that June sell-off, we got down to almost -1.5. And there's the selling. Kind of looks somewhat familiar, doesn't it? Maybe not exactly the same. Had a big move down, big gap up, a little bit more selling, and then a final gap down marked the bottom. Moved up for a little bit, went back down, nearly had a double bottom, pretty close before we started our next advance. I could see something similar to that. Actually, I'd like to see this. I think this basing for a couple of weeks would be a good idea for the market. I think it would be healthy, but we'll have to see how it develops. But I wanted to point this out. This is a longer term. Or no, actually, this goes back into June. So here was that June move down. Now, one thing to look at when we put that last low in on June 15th, see how we went down, put in a lower low? That's when the PPO just started to turn back to the upside. So we had a very slight positive divergence, and that ended it. That was the low. So maybe we need one more move to the downside. That would be something to at least watch for and consider. But the other thing I wanted to point out was this long-term chart. Okay, so this is a 1-hour chart, but it goes back 5 years. I'm not worried about trying to pinpoint where we are, here on the chart price-wise. What I'm looking at is the historical PPO on an hourly basis. So when we had the selling back at the beginning of 2016, that was pretty bearish, and the PPO got just a little bit below -1. When we had some residual selling back in June of 2016 right here, went just below -1. After we had topped back in January of 2018, we had that first initial thrust lower, went down to about -1.75. In the fourth quarter, the trade war, when we had that big drop, we got down to -2. Early August of 2019, got down to about -1.5. During the pandemic, of course, that was a huge move down. We got down to about -3.5. But back in June, I was just talking about this, the fact that the June quarter looks similar to what we've got so far now. When we moved back in June, look where we got to, that -1.5 almost. We're at -1.16 right now. And if you look back, a lot of bottoms form right at about this point. So I'm not sure if we're at a bottom, but I think we're close to a bottom. And what I said a week ago to our members at Earnings Beats was, and what I've been saying for the last week, I don't know exactly where bottom is. I wish I was that good to point out an exact bottom. But what I do know is that I believe market's still in a secular bull market. And when we get these pullbacks, first of all, we had a warning at the top. Wrote about it, chart watchers, wrote about it in my Trading Places blog, wrote about it in the daily market report to members. I've been writing a lot about it, the warnings that we have to pay attention to as traders. Buy and holders, don't worry about it. Stick with the bull market. Yes, it's great when it's going up. It's not so great when it's coming down. But if you're in a bull market, you just ride it out. You don't think about it. If you're a trader, some people want to be traders when the market's going up. They want to be buy and hold when the market's going up. But when the market goes down, they want to trade. They want to get out. That's not buy and hold. That's trading. So you first have to understand which category you fit into. If you don't want to really follow the market, you just want to let your money work when it's in a secular bull market, that's buy and hold. And that's what I would suggest. I can't advise anybody. I'm not a registered investment advisor. But from a educational perspective, when the market's in what looks to be a secular bull market, you just hold. You hold through. If you can hold through that pandemic back in February and March, certainly 3 days worth of selling here is fine. I do think the fourth quarter is going to be strong based on that long-term secular bull market belief. So from a trading perspective, though, when you've got sentiment indicators telling you that the market is getting extended and that the market's starting to get fearful as prices keep going higher, that's when you have to pay attention. It doesn't always result in a sell-off, but many times it does. And once you get something started, it's kind of like that proverbial snowball going over the mountain, starting to pick up speed, going down the mountain. Once it starts to sell off, that's when you see everybody jumping in, market makers going on vacation. That's what I call it. They provide liquidity. So when everyone's selling, they're supposed to be buying. But when they see the demand pick up and the selling kick in, I think they go on vacation. I wouldn't want to be buying into, this mass sell-off. And I don't think you see market makers do it either. And that's why we have such quick sell-offs to the downside. But I think we'll stabilize, and I think we'll move back to the upside. Do we have a little bit more to the downside? Maybe. Maybe we get that 10% correction. The NASDAQ's already gotten a 10% correction. I was talking about the S&P. Wouldn't take a whole lot more for the S&P to get there. Maybe 3250, something like that. So we're almost there. Anyway, I just wanted to bring out this long-term perspective. I think a lot of times when you're going through a tough period, everyone's focused on the here and now. And oh my gosh, here we go. We're going down again. This is going to be March all over again. March was a 100-year pandemic. I mean, not that we're not still in it, but that initial thrust of the downside was massive fear. We're not anywhere near that. And I don't think we're going back down anything like that. I could be wrong, but I don't believe we are. I think it's going to be more, consolidation basing, and then I think we move higher. But I thought this was a good chart, just again, from a perspective standpoint. The other thing I wanted to point out, if we go back to this S&P chart back in June, see how we moved down to that new low on June 15th? Look at the VIX on June 15th. So on June 12th, which was a Friday, the VIX was at a high of 44. When we set that new low on the 15th, the VIX set a high at about 39 and change. So the fear wasn't quite as much. So that's something maybe to watch for. If we go down one more time and you notice that the fear is not up at 38, but instead maybe we come down because the market's up, and then maybe we have one more move to the downside, and maybe the VIX only gets up to 33 or 34. That would be another sign that, hey, the fear is starting to come down even though prices are going lower. That could be something to look for. Very similar to what we saw back in June. One last thing I want to just point out, because if you've been getting hit pretty hard, I know our portfolios have been getting hit pretty good here in September. This is the reason why. I mean, growth stocks in the month of September so far are completely out of favor. This looks very similar to what we saw back here at the end of middle of May down to June 8th. You can see how the growth stocks went completely out of favor. And then value stocks, if you remember, June 8th was the day that those stocks topped. The S&P 500 topped on June 8th, and then money rotated back. When? About a month before the earnings season started. I think we'll see something similar. Now, when you saw this relative low come in, we didn't go below these prior lows that were established, especially this one back here in April. That was pretty good relative selling here for about 2 or 3 week period. So we held that. So we keep putting in these higher lows. So what I would be watching here on this, do we hold this low from back in July or this breakout? That's about the same. 1.68 to 170, I think is going to be an interesting area to watch on this ratio. And if we hold that, start to turn back up again, I believe that's going to be a sign that money is rotating back into growth, probably for earnings season. All right, let's keep moving on here. I wanted to take a look at energy. So first of all, here's the chart. And you can see the low back in May. You can see this low in July. Well, we closed below both of them. So, and the volume picked up. This is just not a good group. Accumulation distribution down near 52-week low. I think energy, I looked briefly this morning. I think crude oil prices were up a little bit. So maybe we'll get a little relief in energy today. But watch this declining 20-day moving average. If we can't get back through that, if we get back through it, then I think that just speaks more to the sideways consolidation that we've been in for months. But if we can't get through it and go back down and put in a new low, that to me is the signal of a downtrend. And I would continue to respect that until we can climb above that 20-day moving average. Now, if we look at the different areas of energy, I'm just pulling this up relative, these various industry groups relative to the S&P 500. And I'll go through all of them quickly. I mean, this is the pipelines. You can see pipelines relative to the S&P 500 is horrible. On a absolute basis, watch this low at the end of June, early July. We had this big move up, set a low, moved up. Don't want to break this low, especially with that relative strength line going straight down. Then we've got coal. Coal's been horrible on a relative basis. Look, we've hardly even had a bounce from the pandemic lows. And this looked like it was in a pandemic even before the pandemic hit. I mean, September, actually all the way back in May of 2018 was the high near 80. We're at 5 on the coal index. That's been a brutal area of the market. Stay away. Next up, we've got exploration and production stocks. Are you getting a kind of a feeling of what's going on in energy? Look at the industry group relative to the S&P at a new low. Then we've got integrated oil and gas. I mean, I'm not making this up. This is just a visual that you got here. Look at oil equipment services. I mean, we're off of the March, April relative low. So there's been a little bit of outperformance since then, but we're not far from another breakdown on a relative basis. And this is what the chart looks like. I mean, this is an absolute chart. This looks horrible to me. So yeah, the reason that we're outperforming is that we got absolutely annihilated heading into March. I mean, 260 down to 80. So we get back to 140. It's like, yay, big move. Well, we're still down, close to 50% from where we were back at the end of December. So this group's just rolling back over. Doesn't look good on a relative basis to me. Renewable energy. This is the only area of energy that I would be interested in. And we are getting a pullback like we are across just about every area of growth in the market right now. On an absolute basis, yeah, we've pulled back. But do you see the difference? We went from 70 back in March to 170. This has been one of the strongest areas of the market. So I think this pullback is probably a good opportunity to look for some of your favorite renewable energy stocks. Maybe start, slowly, and be aware of your own risk tolerance. This is a very risky group. This is a group that has high growth, but high growth, if growth is out of favor, falls quickly. And we've seen that. We've seen that with Apple. We've seen it with Tesla. We've seen it with Zoom. We've seen it with all these high growth companies. They're great companies. They're growing their earnings rapidly. But when the market says, enough is enough, you see how quickly these stocks come down. Again, buy and hold, fine. From a trading perspective, watching Tesla go from 500 to 330 at yesterday's close, lost 1/3 of its market cap in about 3 or 4, maybe a week. 1/3. Now, a lot of people would argue, well, it went up too fast. That might be the case. Maybe we're basing for a little while. I like Tesla a lot going forward. And if you look at the chart, it had a little bit of selling yesterday at the open, but its AD lines held up pretty well for the most part during this last week. Anyhow, that's the look at energy. I mean, outside of renewable energy, what are you going to do? It's really hard to continue to support a group that just can't go anywhere. All right, earnings. Oh, wow. Had some big. Oh, actually, before we get into earnings, I do want to show you one other chart. And this is, when we're talking about energy and especially materials, they tend to go based on the dollar. So they tend to do better when the dollar's coming down. Energy hasn't, materials have. This is the dollar coming down. The dollar tends to follow the relationship between the 10-year Treasury yield here in the US versus the 10-year Treasury yield in Germany. So in other words, when our economy is stronger than Germany's, or when it's expected to be stronger, we should see our yields rising faster than Germany. That had not been the case. But it seems like maybe we're bottoming and starting to turn back up again. If this continues back to the upside, the dollar has just begun to turn up. This is going to be a headwind for both materials and energy if this dollar continues moving up and if this relationship between the Treasury yields moves back to a new high. So definitely watch this very closely. Okay, earnings. Let me give some updates on these stocks. I mean, this will just show you how out of favor some of these stocks are. Lululemon Athletica, big beat, 74 cents versus 56. A leader in its group, stock down 3.6%, even with the market up today. The future's up. And let me just see how much the futures are still up. Up 2% on the QQQ, so that's pretty good. But Lululemon, not looking good. How about Coupa Software? Coupa Software comes out, blows the numbers away, 21 cents versus 8 cents. Stock down $6. Maybe the best of all, Slack. Stock down 17%. All they did was come in at break even. Market was expecting a 3-cent loss. Now, they did fall short on estimates of their billings, and that's what a lot of folks were pointing to as the reason for the drop. But it seems like it's a little overdone. But when you look at the chart, I mean, 2440 is way down here below all these prior lows. And really, we haven't seen a low down here since back in April. And this was supposed to be one of those, and I certainly thought it was, one of those stocks that should have held up very well during the pandemic. And we had the big move back in May, June. But since then, you can see pulling back, struggling to get back through this gap resistance zone, and then pulling back. Now we got another gap resistance zone stock's going to have to deal with. It's going to be very interesting to see how this stock performs after it gaps down at the open today. Will buyers jump back in, or are we going to continue to see distribution? The other thing I think is really strange with work is the accumulation distribution. Even since this high and all of these pullbacks, accumulation distribution on this stock was pretty strong. So I was very surprised to see this gap down, or the gap down we're about to see, based on how the stock was trading. All right, let's see, a couple of others. Casey's General Stores, down a little more than 1%. They beat. By the way, every company I looked at last night and this morning, all beat. This morning we had HD Supply. This stock's actually up 2.5%. It had gapped up back in August, worked its way back toward gap support, and now it's up 98 cents this morning. Let's see, Navistar down 4%. They beat their earnings. Then we've got AEO, which is American Eagle Outfitters. They beat their numbers, loss of 3 cents. Market was expecting a loss of 14 cents. Stock still down close to 1%. And then a heavily shorted stock that I've talked about quite a bit with Earnings Beats members. They had a loss of 8 cents, but the market was expecting a loss of 55 cents. So really big beat. Stock down 3%. I think it needs to hold this recent low. Don't want to see this rolling back over. All right, let's move into the three you must see and wrap this thing up. I'm going to start off with Cintas. This is a company I wrote about in the Earnings Beats Digest this morning. So if you're not a Earnings Beats Digest member, but you'd like to check it out, go over to earningsbeats.com, sign in, name and email address. You can get on there. But the look here at Cintas, the reason I'm kind of interested in this stock is when you look at it on a relative basis, you see the strength versus the S&P versus its business support services group. The overall group has been pretty strong relative to the S&P, set a high back at the end of June and has simply been sideways consolidating, going up with the S&P. But this stock's starting to pull back. They report in 2 weeks. If it continues to sell off and gets down, I'm going to say to close to 300, I would suspect that's going to be a really good area of support near that 50-day. And I wouldn't be surprised to see a pre-earnings run back to the upside. Two other companies that will be reporting later this week. Now, again, Cintas is 2 weeks out. Chewy and Peloton, they will be reporting in just a couple of days. Actually, tomorrow. They both report Thursday. This is a leader for sure. Chewy versus specialty retailers. The specialty retail group's been strong. Going to be very interesting to see. I think the numbers will be strong, but we've seen recently strong numbers don't necessarily mean higher prices. And that's the disconnect that I think a lot of traders can't really get a handle on. But many times these stocks have gone up so much, a lot of the good news is already built in. Peloton, near an all-time high, $90. You know, you look at relative strength, this is one of the best performing stocks in the market right now. Huge volume. I think there's a lot of accumulation taking place in Peloton. You can see that in the AD line. But will it be big enough? Will the report be big enough for the market? Again, all those reports I just went over with you, they all beat bottom line, and many of them were still down. Some of them quite a bit down today at the open. So strong results don't always result in strong reaction by the market. And so that's a lesson to certainly keep in mind if you're holding stocks into earnings reports. All right, that is it for today. Let's get a quick look at the market, see if we're holding on to gains. So far, Dow up 273, S&P 43, NASDAQ 191, NASDAQ leading on a relative basis, VIX coming down a little bit. So all of this is pretty good, but the question is, do we hold it? And if we go into that S&P 500 chart, and this is the 60-minute chart, last thing I'll do is update this for you. You know, we're gapping up, but we're not through the 20-hour. So, yeah, it looks good. And if I show you that, was it back in June? No, let's go. Oh, yeah, here in June. You see this move down? You see the gap up? And that's when we went back down and put in a new low. So just because you're gapping up, it feels better at the open, but there's no guarantee this is going to stick. And I've said, you know, as we go through and we have this weakness, I think it is a good time to accumulate, but trying to pick out the exact bottom is very difficult to do. And if you're trying to do that, I think you're probably going to be very anxious throughout this next couple of weeks probably, because market could be volatile. We could see some additional lows, but I do think that we've come down quite a bit based on that hourly PPO that I showed you earlier. So I think that a lot of the momentum, I think we'll start to see that momentum shift, but don't count out one more push to the downside. All right, that's it. I'll be back tomorrow with your next Trading Places Live over at Stock Charts TV. So I'd love to have you join me there. In the meantime, have a great Wednesday. Happy trading, everybody.